Today I'm going to talk about KLA Corp. Going to give a business overview and then run a valuation, sample valuation on base where the price is today. KLA Corp. Are you familiar with this company, Dave?
Nope.
So they are semiconductors and they service the semiconductor manufacturers. So just to give a very high level brief overview, semiconductors, they are what you need. They are the brains of electronics, computers, servers, phones. Even now today, like ovens are becoming smart ovens. And so if there's an electronic, there's likely semiconductors behind it. And there's a lot of different companies that make all sorts of kind of semiconductors. And then there's the manufacturers of those. So you have like the designers of semiconductors like AMD, NVIDIA, Qualcomm, and then you have the manufacturers of semiconductors, which would be TSMC, Samsung, and some other semiconductor companies like Intel and Texas Instruments have their own semiconductor manufacturing plants, which are called fabs. And so with these fabs, they are very highly capital intensive. You got to throw a lot of capital to build them. They take a long time. So, we're recording this in 2022. The shortages around semiconductors have been insane, and nobody's been really able to pick up that demand because it takes so long to build a fab. So if this trend continues where companies start to bring in the manufacturing, we have a lot of talks about people taking the manufacturing away from Taiwan because there's a lot of political risk, bringing that to the United States. Intel's doing it, TSMC's building in the United States. All of these fabs being built would be super great for a company like KLA because they provide the equipment that goes into a fab that helps the fabs test and make sure the manufacturing went through and did well. So it's a very complex process. And so you need that testing to make sure that everything looks good before you move on to the next step. Looking at how they make their money. So the vast majority of their revenues comes from what's called semiconductor process control. Then they have some specialty process and PCB display component. But the majority of that is going to be that process control, which, like I talked about, it's test equipment for semiconductors that goes into the fabs. Big customers are TSMC, Samsung, but of course they have a lot of low ones also. Interesting thing about that segment, over 80% of revenues. In their latest investor presentation, they said they have 4 times more market share for that segment than their nearest competitor. So we talk about dominant in an industry, in a market. For what they do in that segment, they are doing very, very well. To talk about some of the basic financials of the company, returns on capital are very, very good. 10-year median return on capital invested close to 20%. Over 10 years, they've grown revenue at 8% CAGR. And right now, PE is at a 19. Granted, that is on top of a crazy boom where earnings are just insane. Operating margins right now at 36%, where they average more around the high 20s. So they definitely are just flush with cash. You have to be careful when you value a company like that, because if you are too optimistic, you got to understand these things work in cycles. But compared to other semiconductor companies, like if we were to compare Micron, who makes memory chips, to somebody like KLA Corp, it's a very different story. They are not nearly as cyclical as a company like Micron. So I'm going to go ahead and just show a valuation here. This is a sample one I've done. I just took the trailing 12 months free cash flow to equity. This is using a modified version of the IFB equity model that we have for purchase as one of our products. You don't have to know what all this stuff means. This is kind of my way of modifying and adjusting free cash flow to get a better smoothed out picture over the long term. So I put in a cost of equity of close to 9.5%. That is higher than the average cost equity today. And it counts for the fact that this company is more cyclical than your average company. Put in a base 10% free cash flow per share growth rate. You add the buybacks and their historical growth, and it certainly seems possible they could do that. I adjusted for operating margins, again, like I said, because right now trailing free cash flow is really, really high. If we were to more normalize it over a longer period, you would take maybe 3/4 of what they're earning now and try to smooth that out over 10 years. So I get $15.27 per share for free cash flow to equity. I get $351.07 for the value. And we compare that to today, they're trading at 375. So anywhere between maybe 5 to 10% overvalued. But again, that really depends on a lot of different factors, and there's more like a surface kind of valuation.